Let me tell you generally what happens. Initially, people do not know anything about the stock market. So, they come to the stock market, usually they go into the cash market. In the cash market, what happens? Sometimes the stocks never move. Say for example, Reliance Industries was trading around 800 to 1000 rupees for almost 10 years. And people buy, keep it for 8 year, 10 year, they lose the opportunity cost and they don't get any return. And one day they get fed up and they sell the shares. In the next few months, it becomes double. So, people generally perceive that the cash market investment is not highly rewarding. Even you talk to very good experts, they will tell you if you put the money in bank FD, you may get 7-8%, and you buy good quality shares and hold it for a very long term, you may get 10-12%. So, you may get 3 or 4% higher. So, they don't promise you any big return. But generally, people who come to stock market, they are expecting much bigger return than inflation or bank FD. So, at some point of time, they are tempted to go to futures market. By the time they come to the stock market, they started investing, so they talk to the people who know the stock market little bit, they talk to the dealers who are placing orders for them. At some point of time, they come to know about futures, and futures gives you very exciting opportunities. Because if you are buying a contract worth 10 lakh rupees, your margin money may be 1 lakh or 2 lakh, 10 to 20%. So, when you are paying only 10 to 20%, when you buy a stock in futures, if the stock goes up by 1%, you get 5 to 10% return. So, that seems to be very exciting. But what happens when the stock falls 1%, you will also lose 5 to 10%. Then they start keeping the stop loss. And then most of the time stop loss gets hit. And after some time, by the time they realize that the futures is not working, they would have lost most of their capital. Always remember my famous quotation, futures have no futures and options have plenty of options. So, by the time they realize that futures trading is a very high risky business, either they would have lost all the capital or they may be left with a little capital, and with that little capital they want to regain the losses, the entire losses. There is a proverb in Tamil, maybe I translate it in English, may not look very interesting. A gambler who lost most of his capital, with the remaining capital he want to recover and he will lose even more. So, when all these people who lost major amount of money and they go and approach the brokers or other people, they will be introduced to option buying. Sir, you buy option for 1 rupee, it can become 10 rupees. Sometimes it can become 100 rupees also. So, this is how people entice the innocent people into option buying. And I really do not know who are the people who are buying options. That to far away options in Bank Nifty you can see trading it with a very good premium. But there are only few people who escape from all these things and still left with reasonable capital, and they turn to option selling. So, I am not sure in which stage you are, but I welcome to the world of option selling. First, let us talk about the basics. Buyer of an option. What people who talk in favor of option buying, they talk these three things only. Sir, buying of option, you have to pay only low premium money. You got 5,000, 10,000 rupees, you can still play in option buying. But you cannot do that in option selling. Even you want to sell one lot of call option or put option, you have to fork out 80, 90,000 rupees. So option selling requires huge margin money, whereas option buying you just have to pay a little bit of money, only the option premium. Second thing, limited risk. In option buying, you buy an option for 5,000 rupees, the maximum you are going to lose is only 5,000 rupees. You are not going to lose anything more than that. Whereas option selling, that is not the case. The option seller carries unlimited risk, whereas option buyer carries the limited risk. The third one, option buyer has unlimited reward. If a person buy an option for 1 rupee, it can go to 10 rupees, it can even go to 100 rupees. But whereas option seller, reward is only limited to the premium collected. So option seller cannot expect to make multi-baggers. So these are the 3 advantages for option buyers, which everybody tell you, but nobody will tell you what are the disadvantages of option buyers or advantages of option sellers. Here, seller of an option pays huge margin money, whereas the buyer pays only the small premium money, and seller carries only limited profit, whereas the buyer carries unlimited profit, and seller carries unlimited risk, whereas the buyer carries the limited risk. Okay, now I will tell you one by one what are the differences. The first one, huge margin money. Yes, true. Option seller has to pay huge margin money, but whereas option buyer pays only the premium money. But one advantage for option seller can pay that huge margin money not necessarily in the form of cash, he can pay in the form of collateral. Most of the FIIs trading in futures and options in India, they park their money in GSEC. Those GSECs are given as a collateral. And most of the pro account traders, that is brokers trading in their own account, they normally put the money in bank FD and that FD is given as a collateral. Retail people, mostly they buy the shares and give as a collateral, but for the last 2 years, I have been telling the people, if you are trading in stock market, you are already taking a risk there. Then why do you want to take risk with your principal capital? So I am suggesting people to buy the mutual funds, particularly the liquid funds, not the equity funds, or put the money in bank FD and give it as a collateral. But of course, now NSE has stopped taking FD as collateral from the clients directly. But however, there are few brokers, you give the money to them and they will put FD in their own name and they will pass it on to the exchange, and then whatever interest which they are getting, they will be passing on to you. So if you want this kind of arrangement, though I cannot tell publicly, I know few brokers who are doing that. So if you want, you can contact me by mail and I can give you the details. Generally, you can buy debt mutual funds or you can invest it in Bharat bond, which gives more than 7%. And even the post-tax return works out to be 6.5 to 7%. So that is the best possible return right now, and that can be given as a collateral. Whereas the option buyer cannot give collateral. He has to pay the hard cash. So that is one major difference which nobody tell you. Second one, option seller carries the limited profit. Option buyer carries unlimited profit. Tell me, right now Nifty is trading around 9,500 and 10,000 call option I think is trading around 60-70 rupees. If somebody buying that 60-70 rupees, 10,000 call option, when the market goes above 10,000 and he will make some profit. But do you think in 1 month time Nifty is going to go to 20,000 or 30,000 or 50,000? No. How much is going to go maximum? 10,500 or 11,000? So still when he buys for 60 rupees, he may get 200 or 300 rupees. That is actually, in the true sense, it is not unlimited. But intraday is something different. So we will talk about intraday later. But right now we are talking about the positional buying and positional selling. But I tell you, sometimes in your life, when you have something limited, it is always good. Say for example, a person working is getting 1 lakh salary and every month he get 1 lakh salary. So he knows how much he has to pay for rent, how much he has to pay for entertainment, food, clothing, everything, So things goes very well. But a person who is doing a business, so he carries unlimited profitability. But, so that unlimited profitability may lead to some problems. I can give one example. Let us say one person who bought an option for 100 rupees. He carries unlimited reward. It can go anywhere. 100 rupees option can go to 200, 300, 400, 500, it can go anywhere. Let us say he bought an option for 100 rupees, now it has gone to 200 rupees. So the big question comes, will he book the profit? How can he book the profit? He will think it will go to 300. Let us say if it goes to 300, then he will think that it will go to 400. But then what happens? After that, the option prices will crash, it will go to 0. So your psychology will be coming into the play when you don't know. I'm sure when you have been trading in cash market, I'm sure you should have experienced all these things. You would have bought a share for 100 rupees, it would have gone to 150. That time only everybody will tell you, don't sell, it will go to 200. Then what happens after that? Some bad news comes, coronavirus and anything, the market crashes. Then once 150 it has come to 120, then psychologically you have seen 150, you will be expecting that to reverse to 150, you will be holding. And you will be holding until it touches 90 rupees and with a 10 rupees stop loss you get out. So where the problem? Because your psychology is coming into the play when you have the unlimited reward. Whereas option seller, his reward is only limited. If I am selling an option for 50 rupees, I know that 50 rupees is my maximum profit. Either I should get 50 rupees or my stop loss should be hit. Let us say I put a stop loss at 70 rupees. Either my stop loss is hit or my target is hit. My target is 50 rupees. Right? So the psychology will work in favor of option seller. Most of the time, I have seen people saying, sir, I bought option for 10 rupees, it went to 100 rupees, then it came to 0 rupees. Usually that happens on the expiry day. Right? So, in the true sense, it is actually not truly unlimited. And the last one, unlimited risk. And option buyer carries limited risk. Actually, whenever people talk like this, so I really get annoyed. A person who has got 5,000 rupees is buying an option for 5,000 rupees. If that option goes to 0, his entire capital is gone. If I have 20 crore rupees with me, if I am playing only with 50 lakh rupees in option selling, even if that entire thing goes to 0, I still lose only 50 lakh out of my 20 crore. So how can he say that, his is limited and mine is unlimited? Okay, one can say, a person who has got 1 lakh rupees, he buys the option only for 5,000 rupees. Then he buys for 5,000 rupees, that goes to 0, then that became a limited risk. Then after that what he do? He will buy one more option for another 5,000. And that will also go to 0. So in this way he can lose his entire capital one day. Right? In every part of our life, we are taking unlimited risk. Your child is going to school. Okay? Now, you watch the television, one day, one car accident, one child died. Are you going to look at your child? No, you don't go to school. You go to school, when you cross the road, there is a possibility of a car coming and hitting you. There's a possibility you can die. So, it is unlimited risk, don't go to school. No, we don't do that. But what we tell the child, you see the child and then tell the child, look, see the accident, somebody died, so better be careful. When you cross the road, please make sure when there is no green light, don't cross the when you see the green light, only then you cross the road. Otherwise, you don't cross the road. Okay? Even if there is a green light, just for extra safety, you just look at left and right and see that the cars have stopped. The cars are not moving. Right? So, like this, we will be taking precautions. Right? But we won't say that no, because going out is unlimited risk, we sit at home for the whole day. So, that is not possible. And second thing, people say, funny thing is that when you are playing in futures market and nobody talk about the unlimited risk, right? You ask them why, they'll say they will put stop loss. But option seller also can put stop loss. What is the big problem? So we can also put stop loss, right? So in the true sense, an unlimited risk, because you keep a stop loss, so in the true sense, it is not unlimited risk. An option buyer, when he buys, he loses his entire capital, whatever he put it on the table. So in a true sense, option buyer also carries unlimited risk. Okay, forget about all these things. Beyond all these things, what one thing people don't tell you, now let me tell you. I'll give you an analogy. If you are interested in buying of option, okay, instead of coming to the stock market and buying the option, I will give you another field. I will give you another field where you pay even lower premium, even lower limited risk, even much higher reward. Low premium, you still pay 2,000, 3,000 rupees premium. And I'll give you one field where you have to pay only 10 rupees. Limited risk, yeah, 10 rupees maximum. Even one cup of coffee, it costs 25, 30 rupees. What is the big deal about 10 rupees? That is the maximum risk. If the reward comes, reward can be 1 crore. So in a true sense, it is a unlimited reward. So you want to know what is it? That's nothing but buying a lottery ticket. You buy a lottery ticket, it costs only 10, 20 rupees. You get the price, you are going to get 1 crore. You don't get the price, you are just going to lose only 10, 20 rupees. But yet, none of you will buy the lottery ticket. Why you will not buy the lottery ticket? Because you know that even though it is low premium, even though it is a limited risk, even though it is unlimited reward, there is a fourth dimension to it, that is probability of winning a lottery is very, very, very low. So, same thing only here also, in stock market also, the buyer of an option, winning probability is very, very, very low. And again, let me repeat here, it is only the probability I am not talking about the certainty. Let us say, now market is trading around 9,500, 10,000 call option is trading around 60 rupees. If a buyer is buying, if the market falls down, he will lose. If the market rises, also he will lose. But the market will have to rise beyond 10,000. Then only he can gain. So, market can go down, can go sideways, can go higher, can go super higher. So, he can get profit only when the market goes super higher. Normal higher, he will not gain. So, the probability of a person winning the game is very, very, very low. Okay, now let me tell you, let us say you got only 10,000 rupees. 10,000 rupees is a limited capital and you want to make it big, very big money, right? then what you can do, you can go to the black market, you can buy a revolver, go to the bank manager and ask him to give 10 crore. He will give you sure. But will you do that? No. Why you will not do that? That is because the associated risk is very, very, very high. If you are caught, then you will be spending the entire lifetime in jail. So you will not do that. So remember, with the low premium and high reward, if both you want, it is possible with the third dimension. Either it will come with high risk or it will come with low probability. Okay, you always remember, with the low investment you want to get high return. It's possible only in two different ways. One, it should come with high risk or it should come with low probability. But in option, they are saying it is a limited risk. So it is not a high risk. So that means what is the natural answer? So the natural answer is low probability. If the probability is low for option buyer, then probability is higher for whom? So naturally for option seller. So option seller though has certain disadvantages, but the probability of his winning is very, very, very high. And in the worldwide, you see 95% of the options expire worthless. So therefore, option selling is better than option buying. I am not saying option buyer cannot make money, but you need to have a huge skills and risk taking ability. An option seller need not have very high skills. Okay, so this is my famous statement. Buying is gambling and selling is like running a casino. Why buying is gambling? It's very simple. How do you define a gambling? Or to put it in a more simple way, I do something. When will you say what I am doing is a business? When will you say what I am doing is a gambling? What is the difference between gambling and a business? And the answer is very simple. A business means you have to set aside huge capital. You cannot start a business with 1,000 rupees or 2,000 rupees. Second thing, after deploying the huge capital, the return that you are expecting, it should be a reasonable return. No businessman will expect double the money in one day, right? So the rate of return that you are expecting from your investment will determine whether you are a gambler or business. So the two main characteristics for businesses need large capital and you can expect a decent return. But once again, I would like to highlight that there is no guarantee that all the businessmen will be profitable. There are few people who can fail in the business, right? But majority of the people will be making profit. At the same time, you come to the gambling. Gambling, you don't need big capital. Even 1,000 rupees, 2,000 rupees is enough for gambling. Once again, I am telling that it is not that all the gamblers lose. There may be one or two gamblers who are winning the prize. I am not saying no. But majority of the gamblers will be losing the money. So you can see the same analogy in stock market. Most of the option buyers are losing. Most of the option buyers are having a limited capital. Most of the sellers have large capital and most of them they are successful, barring few incidences where people can lose also, right? Even Anil Ambani from number one business family in India, so he has failed in many businesses. So business also can fail, right? That's a different story. But most of the businesses make profit. So that is one thing. Now, when I compare the buyer with the gambling, many people are not happy. So now I put it more diplomatically. Buying is like an insurance. Insurance buying, and we all do it. Actually, option buying is like an insurance buying. In fact, I tell you, futures, options, forwards, and all these things were brought for the purpose of hedging only. But people have made it as a gambling. That's a different story. But all these things were brought for the purpose of hedging only. I'm just giving you an example. Let us say if you are in US and you are holding a lot of stocks, in the month of November, there is an election. You remember last time when the election came in 2016, if Trump wins, market will crash. So that was the general consensus. And in fact, he won and the market crashed. After that, it has shot up. That's a different story. So let us say in an election, a particular candidate wins, the market will crash. But there is no guarantee that that person will win. The other person may win, market may shoot up. So what can you do? Can you sell all the shares by thinking the market may crash? If the market never crashes, it shoots up, what will you do? You will lose the opportunity. So what you can do, you can still hold on your portfolio and you can simply go and buy an insurance for your portfolio. That is buying an option. So in case if the right candidate wins, market shoots up, you make profit, you are very happy. A small money you paid for buying of option is wasted. That's an insurance premium you paid, you lose it. But in case if the wrong person wins and if the market crashes, your portfolio will be bleeding, but the put option buy will give you very good profit to compensate the losses of the portfolio. So put option is in fact introduced for that purpose only. But tell me, how many people who buy put option who are holding the stocks? Generally, people who are holding the stocks, they never like to look into futures and options. That's my experience. I know people who are holding shares even for 50 crore, 100 crore, they never want to look at these options. But generally, people who are having a capital of 5,000, 10,000, 50,000, they want to make it very big in their life, they come into the option buying market. Right. So then what is option selling? Option selling is like running an insurance company. So what are the characteristics of an insurance company? Let us say tomorrow I set up an insurance company. I sell insurance premium only in Chennai. And tomorrow if there is a tsunami in Chennai, half of the people die, then how I am going to meet all the claims? I am sure I will go bankrupt. So rule number one, if you want to run an insurance company, you have to sell insurance products across the spectrum. You have to sell insurance to all the people in India, across all the states, so that even in any one state or any one city, if there is some disaster, still you will be able to pay the claims. But there is a possibility, though probability is very, very low, there is a possibility a major disaster can happen and so many people can claim for the insurance money and you may not be able to pay the money. So you are actually running that risk. So what the insurance companies will do, they will go and insure themselves with another company called reinsurance company. For your information, Warren Buffett runs an reinsurance company. So the point here is that if you are an option seller, you cannot be selling an option at one particular strike price and put all the money. No, it doesn't work like that. So you have to diversify. Just like insurance companies sell insurance across India, here you have to sell across the strike prices, across the time frame. So a lot of diversification you have to do it. That is to reduce the risk. But again I tell you, you can only reduce the risk. You cannot bring the risk to zero. So in order to mitigate the remaining risk, you have to buy some options. So buying of an option is only for the purpose of hedging. Just like insurance company, LIC go and buy the premium from a reinsurance company. Buy the insurance from a reinsurance company. Pay the premium and buy the insurance from a reinsurance company. See, the business of LIC is not buying an insurance. Business of LIC is selling the insurance. But to protect themselves from the bigger disaster, they go and buy the insurance. The same way, we are option sellers, our business is option selling, but to protect ourselves, we may have to buy the options sometimes. So that is not our business. Buying of option is not our business, but buying is only for the purpose of hedging. So you must have heard people like Nick Leeson, James Cartier, they all have gone bankrupt. They lost millions of dollars, and probably the risk management practices were not good. And anyway, with effect from June 1, 2020, the SEBI changes the rules where your margin requirement will be very, very less only if you go for hedged position. So from June 1 onwards, I intend to buy one option for every one option sold. Whether I am doing it for the purpose of reducing the margin or not, but I have to do it for the purpose of reducing the margin money. Once the margin money is reduced, your return on investment improves. Right. So that's all about introduction. I hope you have watched the video, the introduction part. Now we are going to the main section. And let me give you the overall picture of the workshop first. If you are watching the one-day workshop, so we will be discussing about 6 different strategies and firefighting and adjustments. And if you are watching a 2-day workshop, then we will be discussing about 12-13 strategies and adjustments firefighting part 1 as well as adjustment and firefighting advanced level. Before beginning the workshop, let me tell you few things. Number 1, successful people don't do different things, but they do things differently. So if you look at our workshop, whatever the strategies that we are discussing, they are already in the Google. Short straddle, short strangle, ratio spread, etc., etc. So they are all there. But then we do it slightly differently. So what way we do differently, you will understand when we go to the strategies. So that is number 1. Number 2, let me tell you very, very frankly, no strategy will work in the stock market all the time. Sideways market, some strategies will work. Trending market, some strategies will work. High volatile, some strategies will work. Low volatile, some strategies will work. But then, how do we know whether the market is sideways or trending? Or how do we know whether the market is highly volatile or low volatile? Sometimes low volatile can continue to be even low volatile. Sometimes high volatile can continue to be higher volatile. Sometimes the trending becomes sideways, sometimes sideways become trending, and the trending also reverses, etc., etc. So the stock market is all about uncertainty. So therefore, no strategy will work all the time. And your success as a trader does not depend upon the understanding of the strategies that we are teaching. Your success in stock market as a trader will depend on how you do adjustments and firefightings in case if your view goes wrong. And in fact, that will be the crux of my workshop. We will focus more on adjustment and firefighting. And let me tell you very honestly, even if you pay $1 million fees, you are not going to get the kind of adjustments and firefighting strategies that we teach in our workshop. I am not praising myself, I am telling you the truth. Number 3, you may be good at strategies, you may be good at adjustments, but still there are certain times you have to take the position, there are certain times you should not be taking the position. So the taking the position is not only mathematics, it's not only the numbers, and beyond this, so there are certain real life things you have to observe. Right now you may not understand, but while explaining one of the strategies, I'll give you the example why I've taken this decision. So there you will understand. That is why I always say, if you want to be successful in stock market, you need two things. One is edge, the other one is hedge. Edge, E-D-G-E, edge. Edge means is the knowledge. And what is the knowledge here? You need to have three kinds of knowledge. One is the strategies, the understanding of the strategies. Second knowledge is, in case if your strategy goes wrong, how you do the adjustments and firefighting. And number three, the real life. What are the factors happening and how those factors are likely to influence the market. You don't have to be very accurate. Let me be very honest. Just roughly, if FIIs keep on buying the shares for last 3 months, even a child knows the market is bullish. There's no need. So we don't need any rocket science. But we should know the real life things and how it is affecting the market. So first thing is that strategies, as I told you, I'm going to explain all the strategies, no need to worry. Second thing, adjustments and firefighting, also I am going to explain to you in this workshop very, very clearly, nothing to worry. But the third one, what is happening in the real life and how it is likely to affect, that cannot be taught in workshop, that has to come by experience. And if you think that you don't have experience, you can always look for somebody. Say for example, I am writing a blog every day in the morning without fail. In fact, I've been writing my blog for the last 8 years, continuously without fail. There I'm giving the view of the market. So you read that blog, you will get a fair understanding of what is happening around us. So with edge, with the strategies, with the firefighting, I'm sure you will be a successful trader. So even before starting the workshop, let me wish all of you to be a successful trader. Thank you.